Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. And today my guest is Paul Shannon. He's a fund manager at InvestWise Collective, where you can break away from traditional investments with an a la carte approach, the freedom to customize your investment journey. Paul is also the co-host of PassivePockets, that is BiggerPockets' new syndication podcast. And Paul should know because he's been an LP in more than 40 deals. Let's get to it. This is episode 232 of Zen and the Art of Real Estate Investing with my guest, Paul Shannon. Paul is a fund manager at InvestWise Collective. He's acquired well more than 200 residential units by recycling equity and JV. He's a limited partner, invested in well more than 40 deals as a passive investor. And all of this led to him becoming the co-host of PassivePockets, BiggerPockets' new podcast on passive investing. Paul, welcome to the show.
Jonathan Green, thanks for having me. Excited to be here.
Yeah, I'm excited to talk to you, and it's been nice to see you guys get rolling with PassivePockets. But it's interesting to think about because when I think of PassivePockets and just, syndication investing, when I was growing up, I didn't hear anything about it. My dad was an investor. I didn't know anything about it. When was the first time that you remember hearing about syndications? And then we'll get to your whole background in real estate, because I know it came after you started with other assets.
The first time I heard about syndications was probably, around 2013, I would say. The Tax Cut and Jobs Act had passed. 2012, big changes were made, obviously. And then I think later on, during Trump's first administration, they made some changes to it again that made it more advantageous for private equity and private placement deals within real estate and syndications. So I had heard a little bit about it. I always kind of wondered what was happening on Main Street. How are these big apartment deals getting done? Is there that much money, with these wealthy families? Turns out there are some that have the money to do these deals on their own. But in many cases, it's a group of investors coming together. There's somebody who's got the experience, the track record, and the know-how to get the job done. That's the general partner.
Yeah.
And they just happen to be connected to a lot of other folks that are interested in real estate, but don't necessarily want to do the day-to-day job or don't have the time. So I thought that was really cool and unique. And it sort of shifted my train of thought and started to think a lot bigger. Originally, I was interested in real estate for passive income and learned from an active experience investing in single family homes that it's far from passive.
Yeah, exactly.
But I still enjoyed it and I still do it today. But it really kind of scaled my thought process as to what's possible.
Yeah, I think that's a recurring theme with a lot of people who eventually get to syndications. Like, okay, doing flips and doing BRRRRs and doing small scale apartments, it all makes sense, but you can't scale just on those assets. It's like having 100 single families versus having a 100 unit apartment complex. It's just one's much easier to manage than the other for obvious reasons. What did you start with though? What was your first entry into real estate?
I bought a duplex that was built at the turn of last century, so 1900s or so. It came with tenants in it. It had, old house problems more or less, and got my my stripes earned the hard way by learning how to deal with maintenance issues, building relationships or lack thereof with contractors.
Yeah,
understanding how leases are structured, working with tenants to be fair on issues that came up in their lives, and getting some empathy behind being a landlord versus being a resident. I held that property for a couple of years, didn't do great on it, but I didn't lose money either.
Yeah.
Learned a lot from it. I bought a couple single family homes, and that's where I really cut my teeth on renovation and rehabs, doing BRRRR type investing and a few flips. And I probably had, 6 or 7 properties under my belt prior to me going full time into investing in 2019. And that's what I was really scared of.
Awesome. Just going back to the first duplex, was it more CapEx just because it looked like a good cash flow deal? Because that's what I worry about for new investors. They say, well, the cash flow looks amazing. It's well over the 1% rule. It's like, well, there's a reason for that. Is that what you got yourself into?
That's exactly right. Yeah. It did cash flow a little bit, but it was, that cash flow was eaten up quickly by maintenance expenses and not having the right relationships with contractors. So overpaying for things that I later learned, that labor and materials didn't necessarily cost as much as what I got charged. So, management trial by fire, more or less. But I guess I always give credit to the tailwinds, right? Because the harder I work, the luckier I get. But it's always nice to get some tailwinds that kind of help you along your way. If you're fighting the headwinds and you're trying to get into real estate, let's say in 2022, which at that point we were starting to shift our focus into getting into larger syndicated deals as general partners ourselves, we were fighting those headwinds and it was very, very difficult. But thankfully got some unexpected tailwinds, during that time when I was getting started and into the COVID era up until about 2022. And that helps. It really does. It really helps to get some macro tailwinds.
Yeah, I like the terminology because I see it as, sometimes that first couple properties, they're not huge wins, but all the experience that you get are the building blocks for the foundation for what you do going forward. But a lot of investors just, they lose a little bit of money on the first one and they're like, oh, real estate sucks. Yeah. And you're like, oh man, you're just going to waste it, because I think you can't really be a good real estate investor and always win. It's just impossible. Things happen in the world, economies go up and down, or sometimes you just pick a bad egg.
Yeah, it happens.
When you went to the single families, were you doing flips or burrs or just general, rehabs or buy, rent right out?
Both. I mean, ideally, we'd like to have multiple exit strategies. Always wanted to kind of grow a portfolio, but then, on occasion we get like unsolicited offers for a package of homes. I was connected with some brokers. Yeah. And, sometimes you look at it and you say, boy, with that price, I'm really pulling forward a lot of the profits that I would get if I held onto these assets and cash flowed for how many years would it take to get that same lump sum? Okay, I'm going to sell these and then reinvest it into something else. So found ourselves doing that a lot of times where the original plan was to own these and hold them in a portfolio. But once we get to that 366 days where it's a long-term capital gain and we would get an offer, we'd really consider it because the tax liability wouldn't be so prohibitive as far as our profits were concerned. But occasionally, if it was the right neighborhood where there were first-time home buyers and, we realized that the house was never going to be nicer than it was and really the numbers worked out better to be a flip, we would do that and take the bigger tax hit. And we got more into that actually as we progressed along. Where I don't know what the ratio is, but I would say we held properties for over a year, maybe 60 to 70% of the time, and the rest were flips.
Yeah, I mean, those are great points. I think if you're a good buyer, you have more opportunities to sell. I mean, buy real estate and wait is a great philosophy. You'll make a lot of money, but you can also repurpose that into higher performing assets because somebody else has a higher demand for the property that you have. I've always said, and I learned from my dad, because the second that the house would be the best house we've ever had, he's like, we're moving. I'm like, well, this is stupid. How does this work? And it's like, well, somebody's coming to the door to pay because you've created something that's better than the other things on the market.
100%. Yeah. And that's the burr strategy, right? It's like, if you can create value, I wouldn't say out of thin air, it's through sweat equity and a lot of hard work and a lot of strategy and a lot of running the numbers, et cetera, et cetera. But if you can buy a house for $100,000 and put 50 into it and it's worth 200 after you're done, you can refinance out all the equity that you put in and keep going. And that same sort of philosophy and strategy applies to multifamily, which I later learned down the road.
Yeah. And also when you're talking about repurposing assets, I'm sure as you got up into these, so many deals as an LP, a lot of it is just repurposing back into the same owner operators. So you really don't ever have to take out the money because in my opinion, why I like syndications now is because they are generally illiquid. I don't want to be able to touch the money. Yeah. It's like index funds to me, but with a lot more fun.
It's funny you say that. Yeah. It's like, I got a deal. I posted about this one time on social media where, I'd invested in an apartment complex in North Carolina in the Raleigh market. And it was like 16 months later, it came to maturity. It exited. And it was like a 30 IRR, but the equity multiple was like a 1.29 or something like that. And I thought, okay, great. I'm glad I got my money back. Yeah. A decent return, but relative to the risk I took, it's not that great of a return. And if I wanted to, evaluate all these deals and go into an illiquid asset and then get my money back 16 months later, I probably would have invested in the stock market. So when I invest in a syndication as a limited partner, I expect to be in that deal for usually 5 years. Today, it's more like 5, 7, maybe even 10.
Yeah.
A couple of years ago, it might have been 3 to 5.
3, yeah.
But anything less than that, it's like, well, why wouldn't I just put my money elsewhere if I want that liquidity?
Yeah, that I really like that, because that's how I looked at it. I really I only started investing in syndications last year. It was just something I started having so many guests talking about it. And I'm like, why aren't I doing this? I really don't want to be operationally significant in it. But, you have this like ego thing of what you like to do. So it's going to be interesting to talk to you about how you got out of that and just let somebody else take the reins, because it was harder for me. But when I chose the right operators, I was like, wow, this is really the future for me and for my kids, because then they don't have to manage it. It's, they don't have to go inherit an 8-unit apartment complex with a bunch of crappy tenants. That's for somebody else to handle.
Yes. Yeah, exactly. I've always looked at it like, if I can be an expert in my local market, which to me requires you to have relationships with everybody in the real estate business that's local to you. That means property managers, other investors. It means contractors, off-market deal flow, lenders, right? So brokers. So all these people are connected in your community. And if you're really tied in, you have an unfair advantage potentially in that market. If you try to pick up and go somewhere else as an active operator, general partner, I always scratch my head when people do it and I see it happen. And I'm thinking, well, if they're the new guys in town, it seems as if everybody that does have the unfair advantage might have already looked over all these deals that they're now getting access to off market. And they're getting these great assets. You wonder what they don't know, right? So for me as an active investor, I always appreciated staying with what I know and being within my niche. And that's a pretty small niche, right? Indianapolis, Evansville markets are where I play, and it's multifamily, residential, single family still a little bit here and there. So it's very specific, and this is a cyclical business. So if things aren't humming along and going well, for me, I still want to deploy capital, and I still want to do it efficiently, and I want to diversify. So I always looked at being a limited partner as a way to achieve that. I can tap into the expertise of other people that are doing similar things that I'm doing in my market, but they're doing them in places like the Sun Belt or Texas or in the Mountain West. These are geographies that I don't have access to from an expertise standpoint. They're doing it in different asset classes like self-storage, mobile home parks, private equity businesses, debt funds, you name it. There's so many things that you can syndicate these days that I kind of get excited like a kid in a candy store. Man, I want that. I want that diversification. There's a place for that in my portfolio. And then lastly, I thought, well, hey, I don't mind diversifying away from myself. I mentioned I got some tailwinds before. I'm happy to share that I feel very blessed and lucky to get some of the deals done that I have along with the hard work. But what if things don't go that way forever? I like to diversify away from myself and get with other operators that have, maybe a better advantage than I have in their market, or they're going to expose some opportunity that I can't locally. So all those things make me excited about investing both actively, where the returns are generally higher, and passively, where I don't have to do anything and the money just shows up.
Yeah, two things. I mean, the local unfair advantage is so important, because I always say, look, insider trading is fine in real estate. It's actually the whole point. Like relationships are insider trading. That's how you get deals in real estate. The longer you're in the business, the more deals just show up on your doorstep. Like you said, now somebody wants to sell a portfolio and they look to you to get it. But also the diversification is so important. And I really like what you said to diversify away from yourself, because you have your niche in your area, but syndications to me, as you were saying, are so cool because I don't have to learn a ton about storage. I can know a little, and then I can learn more by seeing what happens every month, study that. And I have no interest in a mobile home park on my own, but I am interested in one that cash flows, because again, this is just leveraging different parts of asset classes that maybe I don't need to or even want to do a deep dive in, but they're still interesting to me as an asset that I don't have to, go get, a couple $1 million to do.
Well said. Yeah, I agree 100%.
Yeah. Has it allowed you to just think of all these different things? Like, what's one asset class that you would never handle yourself that you love being in one of these passive investments?
Oh, that I would never do myself. I guess I would never say never.
Yeah.
Or I've considered it all, but there's one that I recently looked into from an active perspective, and it was mobile home parks.
Yeah.
And, the property was under contract. We got into due diligence, and utilities were, the topic of the day. We had the plumbers out there to scope the lines and figure out all the infrastructure that was underneath the park.
Yeah.
And it was an education for me, honestly. I mean, I knew about how these deals came together. I understood the benefits. I understood some of the drawbacks. I understand that you're buying almost like a ground lease, but the infrastructure is really what you're paying for. But I really, without seeing it with your own eyes and going through that day where I was out in the cold, with the plumbers and doing the actual inspection, we found that it was something that we were a little uncomfortable with, and maybe a more experienced operator would say, hey, clay pipes, that's what mobile home parks are built on, right? That's completely normal. You got tree roots, all throughout them. And, this is something that we can negotiate with the seller on as far as getting some credit or, cash at closing or whatever. To me, it was a flag that just said, you know what, slow down, buddy. You don't know what you don't know here. You haven't done this before. And yeah, you've got some experience with other residential properties and multifamily, but what you don't know is what gets you burned. So we eventually backed out of that deal. And, it was a good reminder for me that, hey, maybe this is the type of asset that I should just hold passively. But it also gave me that education where now I know some things to ask that operator that maybe a typical LP wouldn't. So I'm just a student of the game. I really enjoy the business, and I get fascinated by, going down some of these rabbit holes that I go down, and I just never want to stop learning. So to me, that's what's exciting about it.
Yeah, I think the greatest power that we have as investors that no one talks about is actually our ability to walk away like you just did, because you can get all the information, get great education, like you said, that can now play a role in maybe investing as an LP. You're going to get way more info because you've actually done due diligence on site. But being able to say no gives you a lot of power. Because I think now with all of social media, there's so many objects out there that look good, but you have to say no to them. And I think new investors get scared that, they have to take action or everyone's pushing them to buy, when sometimes saying no to 3 will get you to the best one.
Oh, I mean, well said. It's, I think a lot of passive investors are guilty of this too. They get into the space and they think that, the first deal that's presented to them is this exclusive opportunity, and they're not going to get access to another thing like this. So they better jump right on it. And the truth, that's how I was too, back early on in 2016. And, we got so many tailwinds at that point that everything you invested in was just fine. But that's not the case, right? It's like this space is vast. It's probably as big as public markets are. It's just fragmented, and it's not very easy to kind of congregate all the different opportunities that are out there. There's not really a great place to have all the sponsors come together and all the LPs come together. I think it's getting better. The community that's over at PassivePockets that I'm a part of is one of those communities. And there is more opportunities now for LPs and GPs to kind of connect versus you just doing an internet search for self-storage operators. Yeah. But the space is large. And I think to say no is prudent. And I always think of it this way. If I'm excited about something and I let emotion creep into my decision-making process, that's immediately where I stop and I say, dude, slow down. This is not an emotional decision. This is literally an investment that is math-driven and risk-driven. And that's how you have to think about it. Not what you see on the shiny offering memorandum or the pitch deck. Let's get factual and leave the emotion out of it entirely. And if I get that emotional feeling, I feel like I should just say no, because I'm letting that kind of drive my decision making when it shouldn't.
Yeah, I mean, emotions you really need to pull out of real estate. We know with regular home buyers, I understand it. I've never been attached because of what my dad's just selling all the houses out from under us. But yeah, I mean, I think when I started investing in syndications, I got a little of that too. I invested in 3 in a row, 100, 150. And I was like, I told myself, just like you, I was like, all right, let's pump the brakes now. Let's just let those start to marinate a little before we do it. And I'm glad I did that. Not because I think I would have invested in a bad deal, but I was like hopped up on the passivity of it. But, $250K, that's enough to just lay out there and see what happens. Mm-hmm. And I've been really pleased with the performance of those 3. So I'm still very interested. But as you said, I'm glad that I gave myself a kind of stop. You're getting too into one thing right now. Just take a break. Survey and look, after that, it's been a weird time. After those 3, it's been weird for a while, just because there's a lot that haven't done well. And I was glad I knew to look at the debt on the deals, because that probably saved me from investing in bad deals.
Mm-hmm.
Hey, it's Jonathan. I hope you're enjoying this episode with Paul Shannon. And P.S. Paul's co-host of PassivePockets and the founder of Left Field Investors Jim Pfeiffer is on just 4 episodes after that. If you're interested in learning more about Passive Pockets, just go to PassivePockets.com and figure out if syndications are for you. Let's get back to Paul. What have you seen over the, say the last couple of years with all of your investments and as an LP, what's the percentage of the deals that are still going well? And is there anything you could have done to avoid it before? Because some people just had debt or they couldn't complete their construction in time with the debt. There's just been a lot of issues with operators that seasoned limited partners didn't expect. And now we're just trying to figure out, what to do.
Yeah, good question. I would say I've been wrong about investment theses in the past more than I've been right, probably. And I think most of us can probably feel that, can empathize with that. What I did get right was back in early 2022, if you recall, the federal funds rate was at 0. Inflation was at about 9%. Up until that point, the Federal Reserve, Jerome Powell, had been sort of telegraphing, or not telegraphing yet, that he was going to raise rates, but saying that inflation was transitory, right? And then at that point in early 2022, he talked about it being more structural and that they were going to have to raise rates. They started to telegraph that was going to happen. And if you look back at history, when inflation was last that high was the 1980s. And the Federal Reserve chairman at that time was Paul Volcker, who is renowned for breaking the back of inflation, quote unquote. And he did so by raising rates into the teens. I mean, it was absolutely ridiculous how high rates were back then compared to today. People just think it can't happen.
Yeah.
But it kind of spooked me a little bit because you saw the irrational exuberance amongst investors, the asset price inflation, along with the consumer price inflation. And you thought, or I thought that maybe this would be a bigger problem. And if federal funds rate goes up, it's not directly correlated necessarily with long-term interest rates in the long end of the curve, but it is very correlated with the short end of the curve. And at that period of time, because the market was so hot, the only way really to acquire deals, and I was specifically looking a lot at multifamily deals at that time, hoping to scale into larger deals. The only way they were getting done was with bridge debt, which oftentimes is correlated with the short-term overnight financing rate, or otherwise known as SOFR, with a spread on top. And if that rate is correlated with the federal funds rate and the federal funds rate is going up dramatically, that floating rate debt is also going to go up dramatically. So if you acquire a property with that floating rate debt and it's going up, that debt service is going up on a month-by-month basis, it seemed back then, that's eroding your free cash flow as an operator, as a business. And cash flow is the lifeblood of every business. So if that's going to put pressure on cash flow, potentially it's going to devalue these properties from where they were. And I just remember back to financial history, what goes up must come down, the history of bubbles, right? And so I got very nervous. I mean, we didn't completely take our foot off the gas, but we were making offers with long-term fixed rate debt underwritten, which was kind of like fighting with one arm behind our back, because really, we were debt service coverage restraining ourselves before it was a popular thing to talk about.
Yeah.
And we were coming in at 80 to 85% of guidance on deals that we were looking at actively. Now that experience, because I knew what was happening in the market with brokers and active deals that were listed, led me to stay away from a lot of the passive investments that were getting done this way, and started to look at the industry a little bit different as sort of a marketing machine, right? It's like the people that can market the best and have this group of investors are making a ton of fees every time they acquire. These deals are aggressively underwritten and a lot could go wrong. Yeah. Now we're seeing today that a lot is going wrong with a lot of those deals. So back to your original question, my portfolio overall is good. I didn't get into any deals that had traditional floating rate bridge debt. I did get into a couple that had floating rate agency debt. Those deals have a little bit longer of a timeline with some extensions that are being worked through, and I have not faced a capital call at this point, although I do think maybe one or two could be looming over the next year. Yeah. There's one deal that I'm in that has, instead of doing a capital call, they're raising a pref equity layer from existing investors, not an institution, which I'm not sure how I feel about. And there's one deal that is not a real estate deal that turned out to be, there's some fraud involved. So I'm learning that lesson too, that, really who you invest with is more important than the deal when it comes down to it. And in this case, the deal was fantastic if it were operated correctly, but it wasn't. So there was money being stashed and put in different places, and it's all being exposed now. So I can't get into specifics there, but like your point at the beginning of the show, not everything goes perfectly all the time. But overall, my passive portfolio is doing pretty well, and there's some good cash flow from it. A lot of it is outside of multifamily and outside of my market per my diversification goals.
Yeah, and that's really the whole point of diversification, is to create a system where if a couple deals don't go well, you have plenty others that are going well to make it be fine. I mean, because none of us are geniuses, and even if we're still not going to get everything right, because things happen in deals. Fraud can happen, anything can happen. So I think that plays into what we were talking about before. If you're spreading yourself out wide, asset wise, geography wise, and just figuring out, again, taking your own expertise out and letting somebody else drive the boat as well, just gives you a nice general portfolio. And then for someone like me, I still invest in stocks too. I'm never all in anything. I like everything to make sure that it's kind of all moving and that I can leave stuff alone as much as possible.
Yeah, I still think there's great value in the stock market from a liquidity standpoint.
Yeah.
Over the long periods of time, it's proven to be a great wealth builder. And it's really kind of set and forget if you're a passive investor, meaning that you just build a portfolio of mutual funds or ETFs and just let it sit there forever.
Yeah.
I think there's use cases for pretty much every asset class out there, bonds included. I was really beating up bonds during that period I mentioned before, where interest rates were so low. It's like they only could go up. And if bond rates go up, the prices of the existing bonds fall. They're inversely related. So, but now today, with the 10-year at, I don't remember what it's at today, but 4.25, 4.5, somewhere in that range. If that falls, which it typically does as the federal funds rate falls, today it's moving in the opposite direction, ironically, which is kind of a phenomenon that hasn't been seen for a long time. But you would think it would trend back down, and if rates fall, those bonds that you pick up today could be worth more. So there could be some money in a pretty safe asset, which is backed by the U.S. government. That's a whole other conversation. Yeah. Is it safe with the U.S. government today owing so much money? But the general point is that there's value in all asset classes. It just matters on what your risk tolerance is as an investor, where you are in your life, right? If you're 20, your goals are going to be different than your 60, and just kind of being diversified across a lot of different opportunities and assets, and being protecting the downside.
Yeah, and I think assessing your own personal risk tolerance is important. We were saying before that we thought, a lot of people jumped into syndications and just trusted everybody because everything looks good. Every PDF that I look at looks like it's going to crush it. But if you really know what you're looking for, you can get through it quickly. But, I've had to identify, I have a high risk tolerance. It doesn't mean I'm risky. It just means I understand the risks and I'm willing to take it. Do you think that's a really important something that investors need to know at some point? Because I think the people who get themselves in trouble is they don't adequately understand their risk tolerance. So they're taking much bigger risks than they even know that they're taking and that they would have wanted to. And probably their family spouse doesn't want them to take those risks.
Yeah, 100%. I think that's one of the biggest problems is that, LPs that are really upset with these sponsors that they lost their money, a lot of the sponsors can turn around and say, well, it's all here in the documents.
Exactly.
You could have looked at it. You could have saw exactly what you were in for if things went the way they went. So yeah, I think that aligning risk is critical within yourself as an investor. And unfortunately, sometimes the hardest way, or the easiest way, I should say, to learn is through pain. Hardest and easiest. Like that's the only way to learn is by getting burned and understanding, man, that didn't feel too good. I don't like that. I don't want to do that again. So now learning from that lesson, you can kind of reevaluate your risk tolerance and get into something that aligns more with it. So there were times it was so frustrating for me to look at deals in 2022 and not just put my foot on the gas, because I realized there was so much opportunity for me as an entrepreneur.
Yeah.
But as an investor, I was shaking my head. No, this just makes sense for me. I think that like self-imposed governor is valuable. Like if you want to have a long-term approach in this business and realize that this business is also cyclical, you're going to have to sort of like break for a while and sit back and relax. The entrepreneur's mentality is sort of to run through a brick wall and face every challenge and knock every one of them down and just keep going. Well, if you do that in this business, you're going to get crushed. There's no wall that you'll be able to run through at some point.
Well, you'll also run out of money.
Yeah.
If you're just always going, you're going to get to a point where you're out of your own money, and then you start using other people's money on things that are too risky because you're trying to, catch something back. I think it goes to what we were saying before about the ability to say, no to something, understanding the risk, and then still being able to figure out, what do you want to do next? And do you even like these things? I mean, I find a lot of people come to me or ask questions about investing in real estate, and they really have done no research. It just sounds good. And when you go into it's like people who are asking about the Burr model right now with 7% interest rates. Like, of course it doesn't work right now unless you're getting the best deal that you've ever had. It's just because there was a book about it, from whatever 7 or 10 years ago, doesn't mean that it works in the same market. The rates are drastically different.
Yeah. And timing is everything. And that plays into luck as well. I think, you discover something and you get really excited about it. I think a lot of people's discovered syndication back in 2021, unfortunately. And now here in 2025, a lot of those folks are saying, I'm done with passive investing. And we've had that conversation in our community. And it's unfortunate because I think there is, a time to be really aggressive and say, hey, you know what, I'm going to liquidate some of my stocks and go into these passive investments. And then there's times to say, you know what, I'm happy with my portfolio. I'm not going to allocate anymore to real estate, and I'm just going to dollar cost average into the stock market. So I think being a student of what's happening around us is so important too. I mean, along with knowing the sponsor, who they are, and trusting them and knowing their track record, and then evaluating the deal. And like you talked about, getting your risk aligned with the deal and making sure it's on point. I think it's extremely valuable to stay on top of what's happening in the market too. Macroeconomics, what's even happening around the world. You think about tariffs and immigration and interest rates and a potential recession, and all these things factor in. They're all connected. It's very complicated to put all the pieces together, but you can certainly say, I'm not really sure about that investment, and I think it fits here amongst the macro picture. And if you know the macro picture, and then you can make a more educated decision as to whether it's something you want to get involved in at this time, or maybe it's something to get involved in down the road.
Yeah, I wanted to touch on something else that you said, because I think it was important. I was thinking about it when you were saying something earlier as well. I think that a lot of the disputes that have come up with people either posting about, oh, these syndicators stole my money, like you said, when you look at the documents, it's obvious, it's all right there. Like, they may have done a bad job managing the portfolio, but the risk is all laid out in the documents almost every single time, barring fraud. Yep. It's there. So I think that a lot of investors lack that personal accountability to say, you know what, they didn't do a good job managing it, but I am the one who chose to go in, and I didn't do a lot of due diligence. I over-trusted. And I think if you know that, you can do a way better job next time. But if you're low on time and you just keep thinking that passive investing is just, quick trust of other people, I think that's what gets a lot of people in trouble. Have you found that because you've, of course, in the community, you see a lot of people who are saying things. There've been a lot of long posts on BiggerPockets about, X company did this, and you see a lot of people going, no, I didn't get the return I want, but I read the docs. Like, it was all there. Like, we knew what they were investing in. It was a fund. People thought it was a syndication and it was a fund. They didn't even understand the difference, and they were invested in it.
Yeah. Yeah, I mean, if you don't understand what you're investing in, that's sort of the cardinal sin of investing, right? You should probably stay away from those types of deals. But the truth is that that's probably more common in our industry or business or whatever you want to call it than in any other asset class like stocks or bonds, et cetera. So I think it's critical for people to get comfortable with a private placement memorandum, with the operating agreement, and go through it each time. I didn't necessarily do that when I first started. I remember one deal I got involved in, I really liked the submarket. I just wanted to be in that market. And the first deal that I saw that came from that market was from a syndicator that I knew their name. So that was good enough. They had a track record, and it was a nice, B-class value add deal. And that's one of the deals that had floating agency on it that I have in my portfolio today that I think eventually might turn into a capital call. And I didn't really do my homework on it, honestly. It was like, it's my personal account, my personal funds. And, I'm pressed on time, and I know this is going to close soon, and I need to get the funds in. So I'll take a flyer on it. And to speak to what you talked about earlier about knowing your risk tolerance, I know that I have, a penchant for, potentially doing that here and there. And it's like, that's okay for a small portion of my portfolio. And, there's a higher chance that it won't work out. And in this case, I'm not sure how it'll work out. But, if I had gone through and really studied everything in that case, which we certainly would if we were investing other people's capital, and get into the finer details, and just had some patience and not felt like, oh boy, I love that market, I want in, I may have not made that decision. So I take personal accountability for that decision. It was just a snap decision. I was probably emotional about it because I like the market. Yeah. Where, if I had just backed up a little bit and thought, let's wait this out, let's study this market more. Let's see who the other players are in the market. Let's learn what a good deal looks like in that space, over the last 6 months. I could have avoided a headache. So yeah, I think investors need to take more accountability. And it starts with education, and it starts by reviewing deal after deal after deal and not falling in love with any particular one. Look at 20 deals within an asset class, and then you're ready to make a decision on what looks like a good deal or not.
Yeah. And like you said with the community, know more passive investors if you want to be a passive investor. If all your friends are flippers, that's not going to help you at all. They probably think passive investing is dumb because you can't keep, flip 10 homes a year. But until I got lucky because of the podcast, talking to a million syndicators, and then I can really understand if someone can talk about it for an hour, I can kind of get a trust level for what I like there. And then that's the first step in my due diligence, like Brian says in Hands Off Investor, like, okay, it's operator first. Then I really like them. Now let me start looking at the asset and the debt and everything around it. And to be honest, I don't go that much further than that. I'm doing the top layer because I'm okay with the risk of me I don't have the time to do 100 hours. I'll never get anything done. So I like you, I'm okay with a little bit of extra risk on one because I'm balancing it against, everything else. But yeah, I think the process has become in some ways a lot more transparent. And then in other ways for the operators who are a little bit maybe newer or possibly even potentially fraudulent, it's out there. Something can look good and just not perform.
Yeah. One of those things that's happening, I think, in the market more and more so over the last, I would say even month, but 3 months, let's call it, is you're seeing a lot more deals that are probably facing, maturity risk, that have NOIs that aren't high enough at this point to refinance at today's rates. And a lot of the common equity is probably wiped out. And instead of some of these syndicators facing the music and saying to their investors, listen, here's where we're at, here's how we got into this mess. It was all spelled out in the documents. Here's what we need to save this deal. Here's why we think we can get across the finish line in 5 years.
Yeah.
LPs don't want to hear that, but we're all big boys and girls, right? I mean, if that's the reality of the situation, let us see all the facts. Let us see your plan on how to fix it, and then let us make a decision. Instead, what I see happening is, some folks are in that same position. Instead of being forthcoming, they're raising a debt fund for their own deals, to salvage their own deals. And they're advertising a huge interest rate that's really appealing if you just look at it on the surface. Wow, it's a big number. I like that. But the risk is insane. Or they're doing pref equity instead of a capital call. Or they're raising a business loan. You can actually buy shares in their business. What's the collateral? Not the real estate. It's just the business that owns nothing.
The business on top of the real estate that's also not doing that well.
That's like a shell company.
Yeah.
So I would like to see more transparency around, what's happening in regards to that situation, because I think that is, if you're an LP and you really don't understand the risk you're taking, you could be throwing, good money at bad. You could be throwing a life raft to a dead body, so to speak. So, some of these deals are destined to not do well, and that's capitalism, to kind of clear the slate, right? You have to have some ups and downs, and that next buyer may have to come in. I think the lenders are going to start to, if they can't pull this equity raise off, or whatever it looks like for a debt fund or for a pref equity layer, these lenders are going to stop extending and pretending if rates stay high, and we'll see more distress in the market this year. And it's really, I hope for the LPs that they realize that this is an opportunity and not the time to say, oh, I'm not investing in a distressed asset, or I'm not investing in multifamily in general. A lot of these headlines are yesterday's news. These are the mistakes that were made a couple of years ago that are now coming to fruition. And that's the opportunity, is that these marketing, gurus that bought all these hundreds of thousands of units are now, crumbling. And it's like, if you can get in there and pick up some of the remains, 50 cents on the dollar, there's big upside there long term.
Yeah, I mean, that's it in a nutshell. I mean, I think if you're a investor who's always paying attention, you know that when something's in the national news, that happened a long time ago. And that's great for me, because it's just going to scare everybody else away from something that I can get a better deal on, if it suits my buy box at the time. But that's why I say it's always important to be looking. I don't always have to be investing or buying. Like you said, sometimes you need to take a little break. That doesn't mean you're not looking at any deals at all. If somebody sends something, it's worthwhile looking at, because you never know if that's going to be the windfall deal, or that somebody needs to get out of it because of distress. Have you found that that's important for you over the years, to you're just always involved as a real estate investor? You can take vacations and things, but if somebody sends a PDF and it's time sensitive, it's probably worth looking at. That's investing.
Yeah. Yeah, I think that's extremely important. And to my experience has been, widely true. I think there's been months or even years on end where progress seems to inch along, right? Where maybe you take a step back and then you have to go forward again. And then it can be frustrating, right? And you want to have results. You want to see good deals. You want to advance, whether you're talking about passive investing or acquiring an active portfolio or whatever the case may be. And then there's periods of time where everything sort of happens all at once. And it's like, oh my gosh, everything I've been working for and all those little inches I've been gaining over the last couple of years are culminating now over like a really short period of time, like a month. And all of a sudden there's these great investments and you've got to pull together all this stuff and you got to make everything work in rapid fire. And you advance like 5 years in a 3 to 6 month period.
Yeah.
So, I look at that from my entrepreneurial experience and I kind of apply that to my investing experience and say there's some times where it makes sense to just sit and be patient and wait and preserve capital and maybe even put your money in a high yield savings account and just have that liquidity available for when that period of time comes where it's time to really step on the gas. You're prepared.
Yeah.
And other people are scrambling. They don't have liquidity. They have debt maturing. They don't have any outs. Well, that's where you can really, really capitalize. So I always try to play within like the ranges. I don't know how to describe this best, but if things are at an extreme, let's call it 75 to 100, I really don't want to be in there. I feel like there's too much downside potentially with market cycles. If it's, the sentiment is too down, I don't necessarily want to catch a falling knife, although that could be the best time to buy.
Yeah.
It just doesn't match my risk tolerance. So I kind of want to play in that 25 to 75 range and ideally in that 25 range, right? Where you see the upswing and you know that we're in an expansion period now and it's time to really go. And it's hard to identify sometimes, but if you give yourself enough room for error, I think you can do pretty well through diversification.
Yeah, I agree. So tell us how InvestWise Collective came together, because I know it came from you eventually meeting Jim, who's now your co-host at PassivePockets, and then getting into that community and then starting this yourself.
Yeah, InvestWise was really a partnership with left field investors who eventually became PassivePockets.
Yeah.
Since then, we became autonomous and we split off. The relationship is still in place with PassivePockets, but InvestWise is standalone. And the impetus behind it was really that we were frustrated trying to find multifamily deals locally to us, back in 2022. And we were finding other opportunities as passive investors in different, sectors and different areas of the country. We're pretty well connected with a lot of different sponsors. And we thought, well, if we could, instead of invest 25, 50, 75,000, whatever it might be of our own money, bring along other investors that are interested in passive income. And we're not registered investment advisors. We don't claim to, have the Holy Grail. We don't tell people that we're advising them to do anything. We actually give them as a fund the last right of refusal. We'll tell them that we as managers of the fund are investing in this deal. Here's what we like about it.
Yeah.
And here's the risk. Here's what we don't like about it. And then they, as fund participants, get to say yay or nay whether they actually participate in that. It's not like a blind pool fund where they send us their money and we go shopping.
Yeah. That's important distinction, though, for people who don't understand funds, because there's a lot of different avenues. And as we were saying before, some people don't even know the difference between funds and syndications, as a solo, just one-off property.
Yeah, exactly. So, we like the sort of anti-niche approach that we're taking. I think a lot of entrepreneurs would tell us that we're crazy. We need to really focus in on one specific niche in the market. In a cyclical business, as I mentioned before, I just don't think that that's effective all the time. Eventually, you try to jam, a square peg through a round hole. So, and that's what we were doing for a lot of 22.
Yeah.
This endeavor was really designed to allow us to be asset class agnostic with larger check sizes. Through aggregating money from our investors, we could negotiate better terms or get access to deals that have really high minimum investments that we couldn't participate in individually. So, that's been sort of the play. And, to date, we've really found a lot of strong risk-adjusted returns in debt, moving down the capital stack. And I'm not talking about debt funds like we were before as rescue capital necessarily into operators.
The mezzanine world, is a little scary.
That are already distressed. I'm talking about the fact that, because interest rates rose so quickly in 2022, a lot of lenders got a little skittish and disappeared from the space. The collateralized loan obligation market dried up. A lot of access to capital became scarce and for a while there, and it's coming back. But debt funds, private money, basically grouped into and allocated into a fund and then deployed into specific strategies, has become a lot more popular. And we found some deals that we feel offer really good risk-adjusted return and offer cash flow. And I think a lot of investors had distributions paused, capital calls. They're starving for that passive income that was supposedly get them the financial freedom. Well, if we can earn equity-like returns and get current pay distributions in the low teens and have redemption capabilities where we can get out of those deals and rotate into something more aggressive when it's warranted, in our opinion, that has some really unique characteristics. And debt funds have only grown in popularity since we first got into them back in 2023. So we still think there's a runway for that type of asset in a portfolio, similar to like a bond, in a stock and bond portfolio. So, but we're, again, asset class agnostic, and we're looking for unique opportunities with good stories behind them that have, good stories that preserve capital and, obviously have upside down the road, ideally. But, we think that this year there should be some more stuff to look at that's attractive. So,
yeah. And so far with PassivePockets, you guys have been running now for a while. Have you seen that there's a lot more interest in syndications from newer people than you thought? Because that's what I'm seeing now. Maybe because I'm just telling newer people now as well. I'm like, listen, if you have capital, don't do a flip. You don't know what you're doing. Your risk is way higher on that than investing with someone passively. Again, just let your money do the work. Are you seeing that as well?
Yeah, I am. I mean, it's extremely difficult if you're a new investor and, you were on the BiggerPockets side and you're interested in single family flips or burr investing. I mean, it's a very difficult time to be in the space. We were extremely active through 2022. Actually, we had some unique banking relationships and some in 23 as well. But for now, with rates where they are, I think you alluded to it at the beginning of the show. It's like, it's really difficult to make things pencil and make it work. So yeah, I would say good advice, right? There's potentially better yield for less work on the passive side right now. We are seeing that there are people that are coming over from that, that kind of mantra and that space and getting more exposed to syndications and understanding where, investors from the last few years have been and kind of learning from that, not necessarily through their own experience, but just a cautionary tale, right? And I think that's what that last crop of investors maybe that got into it when I did, didn't necessarily ever experience. You don't know what you don't know until you experience a downturn. So hopefully this new batch of investors that's coming in now and getting exposed to passive real estate investing learns from those mistakes through osmosis and can kind of be better prepared for the future and structure their portfolios more prudently. But I think the space is really in its infancy, and the issues that have been faced over the last couple of years are good for it. It doesn't look like it right now, but potentially some more regulation might be warranted. More education, just understanding again what you're investing in is so critical. So anything that can be done to get people more up to speed on the merits of the asset classes, but also the risks are going to be very good steps to take.
Yeah, I think that's a great point. And I think, as you were saying before, more transparency is great. If you're looking to invest in syndications and, the documents have everything, and then when you send a small list of questions, you get answers right away, that's a good sign. I think sometimes people take other people's questions and they try to put them into any deal. And it's like, well, those questions don't actually make sense. So they don't get the answers that they want. They think the deal's bad, but they're just not experienced enough. And that's where these groups, like we were saying, of people crossing over from your traditional BRRRR, Section 8 rentals and saying, I don't want to do all this work. Nobody really likes being a landlord, no matter what they say. It's not fun. It's a lot. You may do well at it, but it's not, it's another full-time job. Everybody knows that who has an apartment building of their own. So I think it is going to be interesting to see what people do and how they start to assess. And I agree, if there's more regulation, I think that's fine. Same in the short-term rental space. People say, wow, there's more regulation. Well, that just means the operators who are ahead of the curve and are already in compliance in advance are just going to do better for the long term. Right. So it doesn't faze me. Like all that stuff, I think helps, as you said.
Yeah, I would agree. And one point you made there too, I want to elaborate on a little bit, is just the standard list of questions. I don't think there is one. I mean,
Yeah.
I've written an article that has 50 questions you might want to ask a sponsor, but until you get into their deal documents and understand what the offering is all about, that's where the real questions are derived. And shameless plug for PassivePockets. Internally, if you're a subscriber to PassivePockets, you get access to what's called a deal review series, where we interview operators. They give kind of a consolidated,
right. Yeah.
Snapshot of their offering, assuming that, if you're watching it as a viewer, you've already kind of reviewed the longer deal webinar. And the second segment of the show is a panel of limited partners that asks questions to that sponsor.
Yeah,
and
that's
lot
cool.
of the questions are really pretty deep dive stuff, like reading through the PPM, reading through the operating agreement. So it can give a newer passive investor kind of a framework to understand how to approach a sponsor and what questions to ask potentially in a deal. And then the LP panel lets the sponsors go, and we all rap out about what we thought about it. So it's a unique format, and I think it's received pretty well. But it's a good sort of playbook or educational piece to get more up to speed on what you should look for as a passive investor.
Yeah, and just to go back on the questions thing before we hop off, I think it's really important. When we were saying before that it's important for investors to be able to say no, I find it respectful for GPs to say no to LPs. Like, you just don't want everybody's money, because if someone sends you a list of questions and they're all like directly answered in the PDF, I don't want them, because they're going to be a pain. They're not going to read any. They want you to interpret the documents, and that's the whole reason you became a GP is so the LPs are quiet. You churn them money and don't give me a lot of emails. That's the whole point. So do you think that's important as well? I mean, comparing it to what we were saying before about our own willingness to say no, I like to see GPs who are not open to everybody, because the good ones just have a wait list. They're just going to recycle the money and pluck the people that they want from referrals. Yeah,
I mean, it's a long-term relationship, right? So it's got to be beneficial for both sides. And there are LPs that are more sophisticated. They're going to get into the weeds a little bit more.
Yeah.
And for some general partners, those questions could be met, with just not a willingness to really go down the path of answering those. And I think as an LP, you learn, okay, well, that's good. That's not a relationship that is working out already on the front end, never mind for 5 or 7 years. And then there's probably it's the old, do you fire your customer, right? I used to be in sales, and it's like, eventually, you want someone's business, right? But at a certain point in time, you realize, I can't help this person. I've given them so much value, and they're just not going to be able to understand, what that value is. So at that point, it's just like, okay, maybe this relationship isn't meant to be. So yeah, I think it works both ways for sure.
Yeah, I agree. Awesome. Paul, is the best place for people to get in touch with you outside of following you guys and listening to PassivePockets at InvestWiseCollective.com?
Yeah, that's the one. I'm also very active on LinkedIn, so you can check me out there.
Yeah, I've been talking a lot with people. LinkedIn has become more spammy, but that's where the business people are. So we were just recording. It might have even been last episode, and we were joking again like this at the end. It's like, why are you spending time on Facebook? That's just a bunch of pictures of food and what people's kids are doing, which is awesome. But that's not where you're making business to business relationships and finding passive investment opportunities. It's on LinkedIn, because that's where the business people are.
Yeah, I probably shouldn't admit this, but I think I have a Facebook account. I deleted the original one, and then I got on again to check out a few local meetups that were advertised there. I don't have a Twitter account. I've never been on TikTok, but I'm all in on LinkedIn, and I agree. It's the place to go for what we do. I get a little frustrated with it as of late, with just a lot of ghostwriters.
It's a disaster.
Yes. Yeah. And just even bots that are answering, and commenting in people's posts. But
it's so obvious, though. I mean, I've actually made a lot of posts about the bots and the ghostwriting, because I think it's a little bit crazy. I can tell. But, if you know who's doing it for real, you can tell. It's like when someone connects with you on LinkedIn and then they immediately send a 3-message email thing. I'm like, I can't unfollow and disconnect fast enough. It's like, this isn't why I'm here. I'm really trying to build relationships. And I think if you do that on there, your just chances of getting higher end relationships are so much better on there than any other social media that's out there.
Yeah, I couldn't agree more. I could spend, 15 minutes talking about when I get frustrated, then I fall back on how much benefit I've actually gotten out of the, what I put into it, and it's massive. So I definitely think it's worthwhile. Just kind of ignore the ghostwriting people and the bots.
Yeah. I mean, their format's the same on every post, so it's pretty easy to tell. It's like one sentence space, one sentence space, one sentence long sentence space, period, emoji. It's like, okay, I've got the formula here. Let's skip it.
You don't have to be Sherlock Holmes to pick up on it after a few days. Like, wait a minute.
Yeah. Awesome, man. Well, I really appreciate it. I know I'm having Jim on a couple episodes after this, so it'll be good to have you both on back to back. But I love the conversation, and I look forward to staying connected with you guys. And hopefully everyone, if they haven't been listening to PassivePockets, they're going to hop on over and give it a go.
That's great. Jonathan, I really appreciate having me on today. It's been a fun, free-flowing conversation, so thanks a lot.
Yeah, all right. That was Paul Shannon of InvestWise Collective. You can find him at investwisecollective.com. And as we said, on LinkedIn. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode of Zen and the Art of Real Estate Investing. And episode 233 is a surprise solo show, because I've been thinking a lot about accessory dwelling units. I've had Derek Sherrill, that ADU guy, on the show, but I actually have a very long history with accessory dwelling units, and I talk all about it next episode. See you then.